Welcome to The Economist Next Door, a podcast where we make complex economic ideas accessible. No PhD required.
The state will continue paying out these benefits. They'll stop paying for police and fire before they stop paying out these benefits. These unfunded liabilities, these promised benefits are crowding out other areas of spending. And one of the difficult tasks of educating people on this subject is that we don't get a bill in the mail from, the state government or from the municipal government that says you have to pay X number of dollars into the city or the state's pension fund.
Yeah, it's not,
There's no direct bill, but what you do end up seeing is your taxes going up, but the potholes in the roads aren't getting filled, textbooks in the schools aren't getting updated, and all of these little things on the edge that you see the costs of government going up and you end up wondering, where is all my money going?
In today's episode, I'm joined by several of my colleagues on the Economic Freedom team here at the American Institute for Economic Research. Research fellow Pete Earle, Jason Sorens, and Tom Savidge. We'll discuss several issues of political economy, such as how many public policies make housing more expensive, how badly most state governments manage their pension programs, and the sustainability, or rather unsustainability, of government spending. Let's get started. We actually have a special short segment for you today because the Supreme Court ruled last week that a bunch of Trump's tariffs were not legal. So I was able to sit down and talk with two of my colleagues at AIER, Julia Cartwright and Thomas Savidge, who are both research fellows. And we wanted to give you a brief overview of what was the Supreme Court doing deciding this case? Why was it before the Supreme Court? What did they actually decide? And does this mean that the president can't use tariffs anymore to protect the country? I think those are sort of three important questions here. So, Julia, Tom, thanks for joining me. Tom, maybe you can kick us off. Why is the Supreme Court ruling on the tariff policy that the Trump administration's put into place?
That's a great question, Paul. And I think as we'll see, as the details play out over the next couple of days, we'll get a deeper explanation. But I think it all comes back to Civics 101. Who in the U.S. government has the power to tax? Who has the power of the purse? And at the end of the day, that is the legislature. As we've seen over the course of the 20th century, the executive branch has grown with a massive administrative state. But ultimately, that suit came forth and the Supreme Court decided the way it did based on, who really has the power to tax. And, that falls under the legislature, that falls under Congress, and it's not the president's decision to make. Although there is this International Economic Emergency Powers Act, the Supreme Court has ruled that the president has taken too much latitude with that particular act and is doing things that really Congress should be doing in the first place.
That's right. And that act has been around for quite a while, I think 50 years or more, and has never been used in this way. And Trump has basically said, well, because of this act, I can kind of do whatever I want. So, Julia, maybe you can weigh in on, so the Supreme Court struck down his ability to use AIER is the name of this act, or the acronym. And he's basically used it to say, I can do whatever I want. I can set this tariff today and that tariff tomorrow. I can tax this country at whatever rate. Why is that? Why do you think the Supreme Court struck that down? Why is that maybe problematic from a good government standpoint?
Well, it's problematic in a variety of different ways. One, as Tom mentioned, it gives the executive power, the executive branch, just this very sweeping power. And that was the majority of their decision, said that the president cannot just impose tariffs at will, especially sweeping tariffs. There are acts like Section 232, the Trade Expansion Act of 1962, and Section 301, the Trade Act of 1974, that allow the executive branch to impose various tariffs, but not necessarily sweeping. They do have to have a reason. The reason cannot just be, I was offended by a country or gotten some particular spat, which SCOTUS was making very clear in their ruling. And this is a win, I would say, on the margin for federalism in the U.S. We have seen this administration just codify a lot of power in the executive branch, like we have with past administrations. However, this administration is being very blunt and overt about it. So I think this is a happy win for some more sound economics and also more sound federalism.
Yeah, I think that's right. It's a win for the rule of law, right? Because one of the differences between the rule of law and the rule of an individual person is the rule of law. You have procedure, you have metrics you have to hit or justifications you have to have, and you have courts that arbitrate that, and Congress is involved. And so we're moving back towards a tariff policy that is legislated and procedural and rule-based and following the rule of law, as opposed to based on what one powerful person wants to do on any given day. So I think that's a win for federalism, for the rule of law. Thank you both for weighing in there. For listeners, we're actually going to have a whole episode next week really breaking down kind of the history of tariff policy and what this means going forward in terms of what the Trump administration will do next. They still have the authority to levy various kinds of tariffs, but it has to be justified based on what Congress has said, and there are certain limits on what can be done. So stay tuned for that next week. Well, thanks for tuning in to The Economist Next Door. Economic freedom is really central to what AIER does. It enables people to make plans and achieve their goals when it comes to work, entertainment, food, travel, charity, family, and much more. And so the Economic Freedom team here explores what kinds of freedoms people have or need to buy, to sell, to profit, and also to lose money. There are so many questions related to economic freedom. Should we restrict what people are paid or what benefits they must have? Should local governments be able to tell people what they can and can't build or do on their own property? Should government bodies or agents be inspecting everything from food to buildings to cars and trucks? Should people have to get permission to build hospitals or power plants or schools? Now, I started all those questions with should, but really there's a preliminary step that constitutes the bulk of our work as an economic research organization. We first really have to understand and analyze what happens when those kinds of laws or restrictions are implemented, and that's where our analysis comes into its own. So I'm joined here by three of the research fellows of the team. So I'm joined by Pete Earle, director of the Economic Freedom team, a senior research fellow here. Jason Sorens, senior research fellow. Tom Savidge, a research fellow as well on this team. Thank you, gentlemen, for joining me. Now, for our listeners who probably haven't met you before, maybe you could say just a little bit about how you got interested in economics, a little bit about your past, how you got to where you are currently, and some of your sort of general interests on the Economic Freedom team. Tom, let's go ahead and start with you.
Sure. Well, it's kind of a windy way. I originally studied political science and philosophy in undergrad and came to quickly realize I also needed some economics training. I was kind of hard pressed to figure out how I could get that training quickly and outside of the classroom without taking on another major. I had asked a buddy of mine if Macroeconomics for Dummies was a good book, and he said no. Economics in One Lesson by Henry Hazlitt. And so I got that, and that really dove down to the rabbit hole, and the rest is history, as they say.
Okay. And then you went on, you did a master's at George Mason, right? In their econ program?
Yep. Well, I did the master's in public policy, and there I did a fellowship with the Mercatus Center, the Bastiat Fellowship. So got some additional economic training on the side, worked at the Mercatus office for a bit. I gave grad school a try. And when I found out I didn't earn funding for the second year, I analyzed the potential trade-offs of taking on more debt or going out and looking for work. And I had decided to try my hand at the working world. And from there, I had a job. I had a quick job at a foundation just after grad school, and then got a position doing state and local public finance research at ALEC. And then from there, after spending years studying state and local government debt, the opportunity to come to AIER opened up, and I hopped on that chance as soon as I heard there was an opening.
Yeah, excellent. Well, I'm glad that you did. Jason, why don't you tell us a little bit about sort of your background, what brought you here?
Well, it's amazing. My story is a little bit similar to Tom because I did an after-school program in high school called 10 Pillars of Economic Wisdom. And the first thing that they gave me to read was Economics in One Lesson, which converted me from a 14-year-old Pat Buchanan fan who thought, high tariffs must be great. to, a free trade, free market guy. And the rest was history, and became a sort of fervent classical liberal, and have pursued those ideas throughout my career.
And you did your PhDs in sort of political theory, right? But you tend to do a lot of economic writing and research and analysis. Am I right in that?
Well, my PhD is in political science, but my primary subfield was political economy.
Okay.
So I've always had a lot of that focus. I do read a lot of philosophy. Sometimes I say I have philosopher envy, but but yeah, my work has always been very quantitative, very focused on the data and trying to understand what it tells us about human behavior and how policies affect the economy.
Sure. That's great. Well, and then, whatever you want to share, especially on like the economic freedom and sort of leading this team, whatever you want to share in terms of your background interests and sort of how you got here and why you're interested in this team.
Well, I hated Econ 101, and I swore I would never take another economics course. Stay away from economics as long as I could. But like a lot of kids of the 80s, teenagers of the 80s, I became interested in Wall Street. When I got out of the Army, I got a bachelor's degree in engineering. When I got out of the Army, I went to work on Wall Street. I became a trader. And I did that for 21 years in different roles, got an MBA in finance on the way. That was actually me dipping my toe in the water because there were a few economics classes there. I said, all right, this stuff actually makes sense. I get it. And of course, watching the Fed and the financial markets and all these things every day, you get curious about them and you start learning about them and you find out that there's more to them. I guess it suddenly made sense to me why you would study economics, right? And so in the last maybe 10, 12 years, one of the things I saw happening was I saw that technology was replacing traders. With big trading desks of 30 or 60 people were being replaced by 5 traders and 3 PhD programmers, usually not programmers, but physicists. So as I watched that occur, I thought that I could do something similar, but I've always done programming. So I got a master's in applied economics from American University, which was very quantity. There was no, economic thought or anything like that. And then through a number of twists, which we can discuss another time, I came to AIER. And while I was here, I did my PhD. My PhD is in economics and economic science at the University of Angers in France.
Excellent. Well, I sometimes tell people that a lot of the top econ grad programs are really like applied mathematics that occasionally look at economic problems.
As a matter of fact, I think I read somewhere last year that economics was the equivalent. Economics was basically reclassified as STEM in China.
Wow. Same.
Yeah.
I mean, this is why I got my PhD in political science, actually, because I did not want that kind of approach in my graduate.
Yeah, the program I did my PhD in was not very quantity either. I mean, you could go that way if you wanted to. Right. It was much more about, ideas and also about, empirical stuff outside of the quantitative realm.
Excellent. Well, good. Well, what I want to do today is we're going to have sort of a conversation about some of the general areas that I know you all work on, some areas within the team. And I think maybe to kick us off, thought we could start out having a little bit of conversation in sort of Jason's wheelhouse, which is looking at housing, zoning, affordability, the supply of housing. There's obviously so many issues here. A lot of people are talking about affordability, interest rates, and so on. But Jason, why don't you kind of kick us off here in terms of what are some of the really big ideas or things that would be helpful for people to know about the way housing is built, the way that people use it or don't use it, and some of the constraints or reasons we've seen kind of a spike in housing prices, especially over the last 5 to 15 years.
Yeah, and the salience of this issue has grown a lot over time, and I've been working on it for about a decade. So it is really, at the end of the day, basic supply and demand, but then you have to kind of work through how this plays out. So when you think about who supplies housing, it's landowners and developers, right? So if you own land, you might sell it to a developer on condition that they're able then to subdivide it or get the permissions they need to build something on it. And what we see is that local and state regulations play a very significant role in your ability to develop things on your land, right? To build apartment buildings or to subdivide, how much land you need to have to put a house on it, right? And so that really affects the supply of housing, and in particular, what economists call the price elasticity of supply, right? So how much supply responds to demand. So housing demand is growing in the U.S., not just because our population is growing, but also because our population is aging. And so more and more people want to have places of their own. right? And so we're getting what's called household formation, right? People want to have their own house, and supply has not kept up with demand, especially in the more constrained, regulated markets in the Northeast and on the West Coast. And so that's where we've seen actually long-standing issues of affordability in those markets, not enough supply. And it's had consequences throughout the economy where, it used to be the case that Americans would move to where wages were growing because that's where the economic opportunity was. Mm-hmm. And that was the case all the way up until about 50 years ago. You start to see that change. And now it's very much almost the opposite, that high wage areas actually have net population loss to low wage areas. We're wondering, why is that? And part of the answer, a big part of the answer, is housing supply. When housing supply is limited and wages are high, the demand is high, costs are going to be really, really high. Mm-hmm. And so especially kind of middle and lower income workers tend to move away from places like California, where the costs are really high, and move to places like Texas and Florida and Arizona and Nevada, where prices are much lower. And so, we've seen a boom in the Sun Belt because that's where people were allowed to build housing.
Mm-hmm. Well, and so there's all the different kinds of constraints that you're talking about in terms of zoning. Environmental is a big part of this. We can maybe talk about some of the environmental stuff that goes on. Something I've been curious about, and I wonder if any of you have thoughts on this, is just the cost of building. So, besides permitting, besides regulatory stuff, but the cost of building materials, of labor, I've heard that's gone up a lot in various ways. Part of it may be due to tariffs, but there's other kinds of factors that are driving that. But so I have thoughts on the cost behind building houses, and maybe some of that's regulatory in terms of who's allowed to work on houses, whether it's electricians or plumbers. But I'm curious how you think that weighs in.
People talk about, I think it's 5 L's, and I may not come up with all of them right now, but land, labor, and laws, and lumber, right? And so when you have, for instance, the U.S. has long had tariffs on softwood lumber from Canada, and the Trump administration has raised those tariffs and raised tariff on steel, which is very important for building up. In places like New York City, to build a skyscraper, you got to have a lot of steel. So that has driven up the cost of housing. Licensing laws for contractors. Some states have them, some states don't, but that obviously limits the pool of labor. Immigration. So if you're deporting a lot of the people who would be often working in the construction sector, that's going to drive up the cost of housing. So there are a bunch of other factors, energy codes, things like that, the building codes, which are different from zoning, but they're the regulations that are meant to tell you kind of how you're supposed to build for either life safety or for energy efficiency. Those can definitely have a big impact on the cost of housing, and not all those regulations are justified in terms of, the cost per life saved, for example.
Right.
No.
You think the 5th L would be location? Like enabling, the weather, it's like we have to build, considering that, maybe
isolation versus
exactly.
Geographic constraints. If you have steep slopes or wetlands, things like that, really make a big difference.
Well, how much do you have thoughts, or anybody have thoughts on, I know this is, again, more of a recent phenomenon, but like in Florida, for example, and this may be the case in California too, insurance rates are rising rapidly. I mean, I've talked to people in Florida who are like, either I'm just going to self-insure or not insure, although that has lots of ramifications about whether you can get a loan or not.
Right.
But any thoughts on the way that insurance, we know that affects car markets, for example, but insurance or reinsurance markets affecting some of these building costs as well?
Yeah, I mean, to some extent, it's the market telling us where we shouldn't be building.
That's what you would think. And then
if
it's competitive,
I mean, that's what I think is so interesting is you could look at areas around the world or even in this country where people either never built for years, or when they did build, they built very sort of simple structures that could be replaced. And all of a sudden, we're paying people to keep on building these areas, which nature, culture, and everything else has told us you probably shouldn't build there.
Yeah.
And over time, it's been subsidized by people in other places of the country.
Right.
So, I mean, that is kind of a stealth form of entitlement that I think is incredible, that I have the right to live in this place that's going to have a terrible storm every 20 years. And I want you guys to make sure I can rebuild.
That's right. Yeah. Somebody else is going to rebuild your house. Yeah.
So, I mean, that's something that there's a lot of layers. I don't think a lot of folks understand it, but that's something that if more people understood, it would probably cause some sort of change, I think.
Yeah.
Yeah. I mean, the National Flood Insurance Program, it's a federal policy that subsidizes building in high risk areas. It seems kind of dumb.
Yeah.
And the thing is, we're not a tiny country like, like Monaco or something where we kind of have to build where we can.
Right.
Yeah, you got a lot of land to pick from.
There's a lot of land to pick from.
Well, we were speaking about this the other day, Jason, in terms of like, it's interesting, the demographic trends. I was talking with a young person the other day about affordability and different concerns she and her peers have. And our houses are actually a lot more expensive than they used to be, say, 40 years ago. And I sort of said, well, yeah, they might be more expensive in somewhat relative terms, but a big difference is that a lot more people are trying to move to cities, the high cost areas you talked about, whether on the coast. And so, if you want to get a house that's priced like your grandparents' house, you go to Ohio or rural Missouri or Oklahoma. There are places in the country where houses are still cheap. It's just that that's not where people are going. And so there's like a demographic shift as well as household formation that drives some of this higher pricing.
Yeah. And you've had states too, like California, that have tried to suppress insurance costs and not allow homeowners insurance companies to price, say, wildfire risk.
And they suspend the insurance.
Yeah. So there's this,
they cancel the policies.
But they it's like squeezing a balloon. It's gonna, the air is gonna come out another area, and so like people have had their policies dropped, and then what these states do is they have these residual policies where the ultimately it's the taxpayer
some sort of
subsidizing, and they're paying the cost of having to pay out when you have these homes destroyed by wildfire. So it really ends up falling on the taxpayer.
And oftentimes the most pernicious part of that, especially with you see this also in car insurance. But what happens is sometimes they won't just cut a policy. They'll just from other, if they have a portfolio of different kinds of insurance they offer, they'll tighten up another area. They'll make it harder to file a claim in some other areas and subsidize in one area. Because these are ultimately companies, right? And I mean, these companies are not going to operate unprofitably. That's probably the biggest thing that the government doesn't understand is that we're not the government. Lost is gather. Right?
They like this cross subsidy stuff going on.
Right.
Well, before we move on, one more thing maybe that we can think about here, and this is kind of a general theme, I think, about, you guys mentioned economics in one lesson, Hazlitt's view there, Bastiat, and what is fun about economics in general is that when we apply the logic and the theory, we often discover fairly counterintuitive kind of results in terms of you do something expecting one thing and actually it turns out totally different. I'll give one example, but then if anybody has an example to share as well that in housing in particular that might be useful here. I was really struck years ago listening to someone talking about parking and parking requirements. If everyone's worried in urban areas, if you build more buildings, there's not going to be enough parking. And so you get certain kinds of parking requirements for apartment buildings and so forth. And what really struck me is this economist was just going through, you realize that if you put parking requirements by unit, you're basically adding cost per unit. And what that's going to do is it's going to encourage the developers to focus on luxury units. So reducing the number of units and trying to increase the quality, because, if you had, say, 100 units and you need 200 parking spots, you can rent those out for a certain amount, a certain size. Or if you do sort of 60 or 50 units that are twice as big, you only need 100 parking spots. So you can actually do that trade-off. And this is part of the move towards luxury development in all these cities is driven in part, at least, by these parking requirements where, again, seems very straightforward. Well, we want people to have places to park. We don't want to increase congestion. But it actually creates this incentive for people to shift the production of housing to create more luxury units, which is, counter to what almost everybody in politics says they want.
I was talking with someone online about this, and I got the response, if you don't force developers to provide parking, it's going to hurt poor people because they may not be able to pay for a spot in a parking garage or something. And my response was, which households do you think have multiple cars that would benefit most from free parking provided with their unit? It's wealthier households. Poorer households are more likely to rely on public transportation or whatever. So it's a pro-poor policy to require less parking. Or ideally, you shouldn't require any parking.
And let landlords make that decision.
Yeah, because the landowner has all the right incentives to provide exactly the right amount of parking that the tenants want.
And you can also get greater specialization where, say, a different area doesn't have a lot of street parking or other kinds of parking, then putting a parking garage in could be sort of a venture, specialize in just doing the parking side of things really well. One more question for you. Could you speak just briefly? This is another kind of counterintuitive thing about economics, but I found great success when I talk to students about this. They've never really thought about it before, which is that in any kind of market, you actually, it's a pro, not a con, to have low quality options as well as high quality options, because everyone is sort of like, well, you got to have standards, you got to have high quality, especially housing. You think about this, but Jason or others, you can speak. How do you think about like quality of housing and maybe how requirements around quality of housing are actually impacting its affordability and then disproportionately affecting those who are poor in terms of their options?
Yeah, I mean, if you force, Ed Glazer had a great quote. He's an economist at Harvard. At an event I went to, he said something like, if you force everyone to buy a custom suit on Savile Row, that is not how you get affordable clothing, right? You need mass market clothing for it to be affordable. In the same way, you're not going to get affordable housing by forcing everyone to do a custom build. Yeah. So there are many regulations that play into this, including things like minimum lot sizes, where, you're limiting the ability of a developer to roll out a subdivision with, say, 60 to 80 houses or something like that. If they are able to do that kind of big subdivision, they can spread out a lot of the fixed costs of development over more units and then price those units more affordably. But if you are preventing that from happening, yes, you will get bigger houses, you'll get more costly houses, but there's only a segment of the market that's going to be, able to afford that option. That's it.
Well, let's move to another area. So that's just one important, big, but one part of economic freedom. Another major part that represents literally trillions of dollars at the end of the day is the issues of pensions and entitlements and public finance. I mean, it's amazing how governments at almost every level, especially the federal level, but states too, they're really like money transfer machines at this point, like transferring from some groups to other groups, whether it's from taxpayers to retirees or taxpayers to unions or, Medicare, Medicaid insurance. I mean, it's amazing how large these transfer programs have become. They've created all kinds of problems all across the spectrum. Tom, I know you write about this quite a bit and you've done it for years. So why don't you tell us just a little bit in terms of what are some of the big imbalances maybe that we see, or how would you describe problems in sort of state pension systems or entitlements and some of the things you worked on?
So state pensions, they're unfunded, what we call unfunded liabilities, which means that once the state makes a promise to a public employee that, hey, we're going to pay you this retirement payment, like they are locked into that promise. And that's different from, say, Social Security or Medicare, where those get called unfunded obligations. Which those obligations can be changed by people in Congress. There's no contractual obligation, but the incentive in Congress is not to change those things because there's political backlash.
So you're saying states can't change the pensions once they've agreed to certain pensions with folks?
Yes. And a lot of the legal structures there, they often follow what's called the common law contractual approach that says, hey, once the benefit's promised, you've got to keep it. And then a couple of states guarantee pensions through state law. And then a handful, in fact, actually, funnily, what some listeners might be surprised to hear is that several states that constitutionally guarantee pension benefits. So that means the state will continue paying out these benefits before anything else. They'll stop paying for police and fire before they stop paying out these benefits.
They're first in line.
First in line are actually some of the states that have the largest unfunded liabilities. And that leads to a huge problem that many of us here at AIER are focused on, crowding out, where, this stuff is crowding out. It's these unfunded liabilities, these promised benefits are crowding out other areas of spending. And one of the difficult tasks of educating people on this subject is that, we don't get a bill in the mail that from, the state government or from the municipal government that says you have to pay X number of dollars into the city or the state's pension fund.
Yeah, it's not broken.
There's no direct bill, but what you do end up seeing is your taxes going up, but the potholes in the roads aren't getting filled. The textbooks in the schools aren't getting updated, and all of these little things on the edge that, you see the costs of government going up, and you end up wondering, like, where is all my money going if all of these problems are persisting or getting worse?
Well, so here's a question for you, just kind of like at a human level, very basic, but how much are we talking about in terms of these sort of pension promises? And if people are concerned about, well, teachers don't make a lot of money, or firefighters, but they're like, we want to make sure we treat these people well. We want them to, have retirement options. I think that's maybe an impulse a lot of people have. Like, how would you describe the way pensions tend to be set up or funded? And are we talking a lot of money here? Is this something that is really excessive in certain ways?
Oh, yeah, nationwide. So that's what's kind of funny, too, because state governments engage in a lot of accounting tricks where official estimates put it at 1.7 trillion, but depending on how you're measuring the present discounted value of these promised benefits, the value, which means the value today of a promised benefit at some point in the future, 5, 10, 20 years out. And they use different calculations to adjust how much they actually owe.
So the idea would be if a state has obligations to pay, let's say $5 trillion in 10 years.
Yeah.
What we want to know is, well, how much money do we need to have today to grow in order to meet that obligation in 10 years? And you're saying there's different ways to calculate how much money we need today based on how we discount. And so one person might say, well, it's just 1.7 trillion and we're close to that. But that might be unrealistic in terms of you're assuming a very high discount rate. You're assuming that money we invest will grow rapidly or tax revenue will grow rapidly to meet that.
Yeah, that's right. And even in some cases, the difference between, assuming a 5% discount rate and a 4.95% discount rate is the difference of billions of dollars. And depending on how you measure it, some pension funds that are assumed to either be fully funded or have a surplus end up having liabilities if you're using lower discount rates. And the reason why some people say use the lower discount rates is because the lower discount rate reflects the strength of that legal promise I mentioned earlier. Mm-hmm. Like if you're locked into that promise, you want a low discount rate that reflects that.
I have a question for you, Tom.
Yeah, sure.
So when we think about these unfunded pension liabilities, do ratings agencies and bondholders and ultimately companies and homeowners pay attention to this? I mean, is this something that affects a state's economy now if it has these obligations that it's going to have to pay in the future? Do people think, oh, my taxes are going to go up?
Absolutely. As far as that latter group, though, that's the one where some people might not notice it because it's, again, like I said, we don't get that direct bill. But of course, the ratings agencies, now that the issue has kind of come to the forefront, people are considering, okay, these unfunded liabilities will translate to higher taxes at some point in the future. But yeah, like it's something that gets factored in. The ratings agencies explicitly mention it. We look at your pension, your promised pension benefits, as well as some of these other benefits like retiree health insurance, Medicare supplement plans. And this plays into much of the larger problems at the federal level as well, because to save money, like say on retiree health insurance, the state government says, well, we're going to close out the retiree health insurance plan. Everybody will just go on Medicare. And so on their balance sheets, it looks like they're eliminating, billions of dollars in unfunded liabilities, but they're really just punting it to federal taxpayers.
And it's that cost shifting we talked about earlier, just to subsidize.
Yeah, exactly. There's something else, Tom, and you can run with this, whatever, but there's also a sort of an antagonistic dynamic that gets set up. I mean, I can't tell you how many times I've spoken to someone and they've said, yeah, I have grandkids, but I better get what's coming to me, and so for that reason, you create this, I won't call it a class, but I mean, you create these sort of tensions in society where, people are promised these things and they expect them to be upheld at almost any cost.
Oh, yeah.
And so
that's absolutely right, Pete. And it's, you think about it, I even remember when I was in high school, I had my AP macro teacher tell us, if, he's like, well, college is expensive. If you, sometimes he goes, you guys should think about taking the civil service test. Mind you, this is in New York State, by the way. Take the civil service test. It's not Hollywood pay, but you're always going to have your benefits.
Right.
And that is what you were told. That is the assumption. That is the assumption going into it. It's like it's always going to be there. You are going to get what's yours, and then people build a life around it.
Right.
And really the problem is, often these policymakers who have a very short time in office, they make these promises. And by the time the promises come due, when, these public employees retire, they're way out of Dodge.
Yeah.
And because, they promise these public employees this fully funded retirement, they're going to get what's theirs. And at the same time, they're promising taxpayers affordable, quality public services.
Right.
And that's, that's why they try to play these accounting tricks on how much do we actually have to contribute to the fund. and all of these other things.
Yeah, let's press on that a little bit. And Pete, I want you to weigh in here if you have thoughts. There's a lot of conversation recently about fraud, right? Whether it's in Medicaid or Medicare, and part of, I think, what people are wondering is, how is this possible? How could there be so much fraud? Like, how could people not be paying attention here? And the reason why I think this is connected is, when you think about the government employees make their plans around these pensions, their salary, and so forth. Maybe you could speak to the problem of, well, who's on the other side negotiating on behalf of the taxpayers? Is there anybody negotiating on behalf of the taxpayers?
Yep.
So what goes to my TED Talk? No one. Yeah. So I mean, one of the things is that there are incentives involved, and that's usually where we go first. I mean, it's a very powerful tool to identify the incentives. And what you find is that, when loans are given for daycare centers or for things like that, they become so expansive. We're talking about billions, tens of billions, hundreds of billions of dollars over years across the different states and the government. There simply isn't the manpower nor the inclination to check. Mm-hmm. If there were a private equity fund or a venture capital fund that was giving out, loans for a creative, daycare center or child center, you better believe they would be checking on the numbers. They would go to visit. They would send in, secret, people posing as customers to ask the right questions. Yep. But there's none of that here. So, and also, by the way, I think there's also a little bit of motivated ignorance as well. Mm-hmm. I do think that some of the, maybe not the case of the that we're seeing in Minnesota, but I do think a lot of times there's a view that, if there are big corporations out there and there are people getting wealthy and all that, sliding a little taxpayer money to certain interest groups or whatever is not bad, even if it gets wasted. Mm-hmm. And as a taxpayer, I couldn't disagree more.
Right, absolutely. And I think there was a line from, I believe it was Michael Cannon at Cato. It said the reason why, the big thing to take away from Medicare and Medicaid fraud is that, it's blatant, it's ubiquitous, and it's somebody else's money. And I think that's getting back to basic econ. It's right. These are taxpayer funds that federal taxpayers are transferring money to the states. And so the states are able to raise spending for their own residents while it's being paid for by federal taxpayers in other states. So basically, I'm buying lunch for Pete using Jason's money.
Right.
And because it's Jason's money, Pete is getting the surf and turf. Somebody else.
Of course.
The Callan 15, right?
If it was just me, I'd say, give me the Lucky Charm.
Well, that's it. Yeah.
Right.
That's right. Well, and the issue here too, an affiliate scholar with us, Corey DeAngelis, has written a lot about teachers' unions, education, and maybe any of you can weigh in on this. I think part of this lack of control is the wages and the benefits that are promised tend to actually be very generous, and there are ways people can goose their pensions by doing a lot of overtime in their last years. But then also we have this rise of just administrative bloat. And so Corey pointed out recently, I think, I can't remember which state, whether it's California or somewhere else, that number of educational administrators had increased something like 30 to 40%. And over the same time, the number of students in the schools had declined about 30 to 40%.
We've seen the same thing in universities. Where,
yes.
The DEI Center and all those have lots of new staffers, some of whom are PhD graduates or postgraduate can't get jobs. And the number of professors and actual people standing in classrooms has decreased.
Yeah. And the DEI people, they're making six figures often, sometimes multiple six figures. Yeah. It's unbelievable. Final thought maybe on this, Tom, in terms of what's going to happen. I really like what you said earlier, because I think, we talk a lot. I think people are kind of aware. Yeah, the government wastes money. Yeah, the debt is a problem at the national level and state levels. It seems kind of unsustainable, but we've been doing it for a while, and we'll probably continue doing it. Is there really a breaking point? And I think your argument about like the crowding out is really good. So maybe who wants to sort of weigh in on this, but how do we see that crowding out? Or Pete, you want to jump in?
So I wasn't going to talk about the crowding out. I can talk about that, but there's a lot of effects of debt and of bloat that take a long time to materialize. Yeah. And, I always, or not always, but I regularly find myself in conversations where people say, disaster right around the corner, right? And I say, I don't know. In 1981, there were newspaper articles that said, we just passed $1 trillion in debt. The end is near. We're at 38 now, right? And I'm not saying it's a good thing. I'm saying that, I think that we actually cheapen the great, epistemological basis of economics when we say, the end is near, we're going to collapse. And we also, by the way, weaken our authority by saying that. What I usually say is, I can't say what it's going to happen. It may happen at 50 trillion, it may happen at 39 trillion. But what I do know is the longer it goes on for without some resolution, the worse it will be when it finally happens.
Right.
And so, that's what I think about these things. And, we generate a lot of distortions with the debt. There's the crowding out of so many entrepreneurial opportunities that might be realized, but, either government subsidies or government actually, entities are doing this type of thing. So, I mean, that's another thing that's difficult about economics, is that it's very hard to make people envision the counterfactual. We can't really say, in physics, you could say, here I use a plumb bob, here we use a feather, you can see this. We can say, well, this is what's happening. Well, I can kind of tell you what might be happening. And people are going to put a lot more weight on what they can see, and in particular, if they like what they see. So that makes it difficult. I mean,
yeah. And that also leads to the challenge of like what's happening now versus what might happen in the future, right? You can see what's going on now versus what's going to happen in 5 or 10 years.
I think too, like, I think that's a great point, Pete. Like, I think you had a line in the Daily Economy at one point that it was like a lot of credibility has been squandered by people trying to pick the exact date of the quote unquote end times, but something that what it might look like when something does happen. I mentioned Social Security and Medicare. Those are federal programs where the federal government is giving taxpayer money directly to Americans. And if those get changed, there could be a lot of political backlash.
Sure.
So before policymakers in Washington dare touch either one of those programs, they're going to adjust funding to the states.
Right.
And right now, and Jason, I'd be interested in your take on this as well because of your work in state and local stuff. But on average, 35% of state spending comes from these federal dollars.
We wrote about that.
Yep. And so the federal government will just maybe adjust how they match the dollars. Maybe they'll say, okay, you states have to pay a little bit more, like 10% more, but that translates into billions of dollars. So then the difficult decision of raising taxes, cutting spending, crowding out other spending, or taking on debt gets pushed onto the state policymakers, and everybody in Washington, just kind of washes their hands of the issue. And they say, don't look at us. We just said you guys had to foot the bill. It was your decision to upset the taxpayers.
So I think that's a great point. And there's another dimension too, and that is that when funding stops or when the government has to choose between, which groups it's going to support, there's going to be a mad rush to the trough. And it'll be an interesting game theoretic exercise to see which ones the government chooses, right? Will it be those who are the most likely to vote, which would be the younger people? Will it be those who reliably show up at the polls, which would be the older people? Will it be those who have the best lobbyists, whatever? I mean, that creates a situation where, you have $1 and 3 people want it.
Yeah.
What ends up happening?
Yeah. No, I mean, I just on this issue of, when the debt becomes unsustainable, a couple of interesting facts here. One is that at the state level right now, you see much lower overall debt burdens than you see at the federal level. So the federal level is really the elephant in the room. I want to say federal debt held by the public is now around 100% of GDP. At the state level, it's roughly 20%, state and local put together. So you definitely, that's where the problem is. And then there's an interesting paper that just came out recently, and it's just one paper, but it looks at the covariance of bond and stock prices over the last year. And it suggests that actually, normally bonds, long dated bonds, are a kind of safe haven. It's a hedge against what happens in the stock market. And that is now going away specifically for long dated federal bonds.
Yes.
And not short dated ones. Suggesting that investors now finally are starting to think about the fact that 10 years to 30 years out, we may be dealing with some serious issues.
That's true, because I've been watching those numbers, and that is the return of the bond vigilantes.
Yeah.
They're starting to trade these bonds, which, by the way, are illiquid on the long end, so they move more anyway, but they're starting to trade them like stocks. Where else we've seen that? We've seen that in Bitcoin.
Yeah.
Bitcoin is starting now to move with stocks, which probably has more to do with regulatory issues. But even so, I mean, when you get all these correlations approaching one at the same time, it usually shows that there's an idea surfacing that might not be friendly to those assets.
Right.
I have to wait and see how it plays out.
Not thinking of them the way they used to.
Right. Exactly.
Well, good. Well, as we kind of wrap up here, one more area I want to discuss, and maybe we'll just kind of do roundtable through your general thoughts on it, is we've gone to some different issues here, the housing, the public finance. But of course, economic freedom is strongly related to economic development, business conditions, growth, productivity elements, profitability, and so forth. And so let's, as we again are kind of wrap this up here, for each of you, let's see, how do you think about this, maybe the state of economic freedom in the U.S., what you've seen in terms of where productivity is going, how markets are doing? There's a lot of conversation about how labor markets, are they weak or are they strong? Or are we seeing an explosion due to lower energy prices and deregulation? So kind of very high level, zooming out, thinking about kind of where we are in 2026, and we've had a year of the Trump administration and lots of different things going on. What would be your kind of very high level assessment if someone wanted to know, how does economic freedom look in the United States? Where is it strong? Where is it weak? What should we be thinking about? Again, I know that's very broad and vague. Give you some time to think about it. Pete, let's start with you. Like, how would you describe just in a minute what your sense is of the economic landscape here?
I'm concerned about what we would call the right, or at least people who formerly held markets in high esteem for their ability to allocate goods, abandoning them.
Right.
We have the president ordering the government to take stakes in private companies, following this weekend's incursion into Venezuela. Now, the president has said that he might compensate oil companies for building in Venezuela. Now, of course, that's a huge project. It could take years to rebuild these mismanaged and in many cases non-functional refineries and pipelines and all that. But I mean, we're approaching a point where across the board, across the political spectrum, markets are sort of frowned upon, or at least they're held, in suspicion. And I think that's a huge concern for a nation that owes so much to markets, and from which entrepreneurialism is and in which entrepreneurialism is such a critical factor in our standard of living. So,
would you describe that as kind of like state or crony capitalism, like this kind of movement from free competition or free market?
Yeah, because most of the places where we see this, I mean, at least off the top of my head, are involving private companies. Subsidizing them, taking stakes in them. That sort of thing. So sure. I do think it's maybe a reassertion of the cronyist inclination that we saw in the past.
Sure. Yeah, good. Jason, how would you describe the landscape?
Yeah, I mean, I generally agree with Pete. I mean, I would say on the one hand, you do have a lot of growth in economic freedom at the state level, again, especially in red states where you've seen expansion of school choice, tax reform, especially cutting state income taxes, zoning preemption to allow for more housing supply. So a lot of good trends at the state level, but at the federal level, I am concerned, especially in the last few months. Early in the second Trump administration, we had some focus on trying to cut government spending, which is good, but that ultimately mostly failed.
Yeah, kind of petered out
things through, and you did end up seeing permanent tax cuts, which I think is a positive. But when you put against that the tariffs, the industrial policy, and just the general erosion kind of in the rule of law and this sort of unilateral executive acting without clear legal authority, I think that is very corrosive in the long term to property rights and freedom of contract.
I do agree that there are bright spots.
Yeah. Oh, yeah, absolutely. I would say it's mixed. I'll talk first about the bad, then I want to end with the good, where, it's a lot of what you guys, Pete and Jason, already touched upon. It's the big thing is the uncertainty. And that's the uncertainty that with these tariffs being threatened. And it's like, of course, I don't like tariffs, but at least when there's some certainty with it, it can be priced in. You can't really price in the uncertainty. And that's why you see so many people, so many businesses just kind of holding still, waiting for the shoe to drop.
Right.
But in the same respect, there are several bright spots. There's a lot of regulatory reform happening. And I would say, too, I concur with you, Jason, that there's a lot of opportunity at the states. And even in cases where you have, say, a state like Illinois, which is, teetering on a budget crisis because they've finally run out of the federal COVID money to keep them afloat. I look back at American history and I think of, the canal bubble and the canal boom of the early 1800s. Now, of course, that caused a ton of state government defaults. Bond investors in Europe heard default in America, and credit ratings for everything in America dropped. But in the same respect, after all of that, many of the first state balanced budget amendments came about. And so I tell myself, while there's a lot of craziness going on, it's always darkest before the dawn. And crisis can also mean opportunity if, people who are willing to stand up for markets, stand up for freedom, are willing to get up and say, hey, it doesn't have to be this way. We can learn from our mistakes and hopefully not repeat them.
I think that's a great point.
That's one of the reasons why we're here.
Exactly.
Is to write about these things and make sure people realize
Yeah,
these things have happened and we pulled through, and it'd be better not to go down that road. But if we do,
exactly.
recovery is possible.
Right, exactly. That's a great way to summarize. A big part of what the Enoch Freedom Team is doing is studying the landscape, state, federal, thinking about what's happening, what's happened before, what sort of solutions can we do now, and what do we do if we need to kind of pick up the pieces later. So, gentlemen, thanks for your time and for joining me here, and I look forward to talking with you again.
Thanks, Paul.
Yeah, thank you.